The first topic for this session we'll be covering is dividend yield plus growth approach in the dividend model. So as we have discussed, we'll be covering is dividend model under cost of equity first, and dividend model we'll be covering is dividend yield plus growth approach. Now how you compute cost of capital remains the same. Debentures was what? Interest divided by principal of net proceeds after tax. You move to preference. Dividend divided by net proceeds or principal. Then you move to equity. Dividend divided by net proceeds or market price. Now if you see, debentures, equity and preference, according to concept you are studying only changes. So if you're doing dividend model plus growth, now what is growth? For example, if I say you're an equity shareholder, I'll tell you whatever you get a dividend last year, I'll give you 10% increase on it. Right? Motivation factor for you to stick. You won't get a constant rate of dividend every year. Based on what you got last year, I'll give you growth this year. For example, if last year you got a dividend of 100 and I tell you growth rate is every year 10%. So whatever you get last year, based on last year, I'll give you a growth rate of 10%. So if 100 was a dividend paid last year, this year I say a 10% growth is there. 10% of 100 is 10. So 100 plus 10 comes to 110. So at the end of the other year, how much dividend you will get? 100 was last year, this you'll get a dividend of 110. Now if I say a growth rate is 10% every year, so next year will be how much? Based on last year dividend, add growth rate 10% again. 110, 10% is how much? 11. So by next year, how much dividend will you get? 121. So by this you add a growth rate every year. It depends on companies what dividend policy they are following. Anyways, dividend policies will go deep when you are doing the dividend distribution time. Distribution of funds time will go deep into dividends that time. But this point of time, just understand. A company also forms a pattern of giving a growth in dividend every year. So the formula changes slightly a bit. How do you compute cost of equity? How do you compute cost of equity is dividend divided by net proceeds or market price. Depending it's a new share or an existing share. Just add growth rate at the end. Just add GE at the end. Because your returns are increasing. We are finding returns for equity shareholder. So returns increases by how much percentage? By how much growth you get every year, right? That's the only change will happen in this formula as such. So dividend divided by net proceeds or market price and growth rate at the end. Depending it's an existing share or a new share. You use a net proceeds or market price. Now, let us do a small illustration to make this method more clear. Dividend yield plus growth approach. Now, a company plans to issue 10,000 new shares of 100 each at par. So 10,000 are what? Number of shares. One share is how much? Rupees 100 each. The flotation cost is expected to be 4% of the share price. Now, what do you mean by flotation cost? Cost of issue. The initial cost which is incurred when the share is issued. So, how much it is? 4% of the share price. How much is one share? 100 rupees. So, 4% of 100 gives you how much? 4 rupees is the flotation cost. Company pays a dividend for rupees 12 per share initially, and the growth in dividend is expected to be 5%. How much the company pays? 12 per share initially. So 12 rupees is the dividend which is paid in the before, and how much is the growth happening? 5%. Compute the cost of new issue of equity shares. So let us do the first part only. Now see, they won't tell you which model it is all about. When you read the illustration, you should know which model they are talking about. Over they're talking about a dividend model. So how do you find cost of equity? Dividend divided by net proceeds or market price plus growth. Very clear, it's a new issue, so dividend divided by net proceeds at growth rate. How much dividend they are paying? 100, 4% of the share price, and one share is 100 rupees. So 100 rupees into 4% gives you how much? 4. So how much is the dividend? Is how much? 4% is the flotation cost. So flotation cost, if I say 4% of the share price, if one share is 100, flotation cost is 4%. So 100 into 4% gives you 4. 4 is a flotation cost, right? See what all is given to you. So we got one fill in the blank. Flotation cost is 4 rupees. Company pays a dividend of rupees 12 per share initially. So how much is the dividend over here? Dividend over here is 12. So how much we got dividend? 12. Okay. Similarly, flotation cost is 4%, which is 4 rupees. One share is 100 rupees. So what will be? You'll use a net proceeds over here. And as we know, flotation cost and cost of issue is always deducted. Deduct 4 rupees from 100. So 100 minus 4 gives you how much? 96. So 12 divided by 96. As growth rate need to be added at the end, at growth rate of 5% at the end. If you solve this part, how much you get cost of equity? 17.5%. And that is how you need to do under the first part. The second part is when do we use market price concept. Now let us understand the second part. If they say the current market price of a share is rupees 120, calculate the cost of existing equity share capital. Now if you see nothing else is going to talk about existing market price which is being traded in the market. In the stock market, what is the market price of a share? It's rupees 120. Just change the formula slightly. Instead of using dividend divide by net proceeds, what I'll be using? Dividend divide by market price. That's it. So depending on the concept, our perspective changes. They're very clear. It's not a new share. It's an existing share. So in case of an existing share, what do? I use the market price of a share, which is how much? 120. So dividend is how much? 12. Market price is how much? 120. Growth rate needs to be added according to the concept. Growth rate is how much? 5%. So 12 divided by 120. If you add 5% at the end, you get the cost of equity under this method. And how much do we get? We get is 15%. That's how you do. See, they won't tell you which method to do. You should understand it's a dividend earning, it's growth without growth, and based on that you continue. So dividend yield plus growth, what did we saw? Same way, how do you find cost of equity? Dividend divided by net proceeds or market price. Just add growth rate at the end.